The United States will withdraw from the Iran nuclear deal.
Actions by the President of the United States can impact a lot, and oil prices are no exception. For most Americans, that means what the U.S. says and does will impact what they pay at the pump. Here's what drives oil prices. World affairs are just one of many factors that dictate oil prices. If you're in the world of oil, monitoring the ebbs and flows of crude prices is second nature. Most investors either follow WTI or Brent Crude. Brent Crude refers to oil from certain oil fields in the North Sea, and it's used as an international benchmark for oil prices. And West Texas Intermediate is one type of light crude that's drilled in the U.S. and serves as a benchmark for U.S. oil prices. If you're not an oil analyst, it may seem like a lot to keep up with. But regardless of which of those contracts you follow, the gist is the same for both. Oil prices are influenced by three major factors: supply, demand, and geopolitics. Supply and demand just has to do with how much oil is available and how badly people want it. Supply has historically been determined by countries that are part of the Organization of the Petroleum Exporting Countries, also known as OPEC. But now, the United States is playing a bigger role in supply thanks to the booming production from American shale fields. So, if major oil-producing countries are pumping out a lot of oil, the supply will be high. Just look at what happened in 2014.
At the OPEC meeting in November, Saudi Arabia made the decision that they were not going to cut back production. They were going to continue to produce at record high levels. At the same time, you had very robust output from the United States and from other producers around the world. It was more oil than the market needed.
Oil prices crashed as producers pumped more than the world could consume. OPEC was largely blamed for the free fall in oil prices because it refused to cut down its production. But OPEC said that U.S. shale drillers were to blame for pumping too much and that they should cut their production first. In 1973, Arab members of OPEC put an embargo against the United States as a retaliatory measure. After the embargo, the oil supply in the U.S. was so scarce and the demand was so high, it drove the price of oil to the point that gas stations began rationing gasoline. Demand, on the other hand, is determined by how much need there is for oil at a given time. Think of the need for things like heat, electricity, and transportation. The more economic growth a region sees, the more demand there will be for oil. And then there's the question of how the market will react to renewable energy.
A lot of this will be impacted by public policy, but at the end of the day, renewables can only displace hydrocarbons if it's economically feasible. Right now, renewables are still more expensive than hydrocarbons, so consumers aren't going to voluntarily make this switch.
Geopolitics. Remember how supply is determined by the big oil-producing countries? Well, if there's tension with one of those countries, like a major war or conflict, it could throw off the supply of oil, which would then alter the price of it.
Particularly when situations in the Middle East or other oil-rich regions of the world would flare up and there would be conflict, you would generally speaking see a little bit of an uptick in the price of oil as a result, just by virtue of the risk of supplies being disrupted or of means of transportation being disrupted, such as canal or pipelines or workers going on protests, things like that.
Just think back to 2003. After the U.S. invaded Iraq, oil prices went up. And with instability in the region, people weren't immediately sure what would happen to the supply. More recently, President Trump pulled out of the Iran nuclear deal and restored sanctions on Iranian oil exports. Oil prices hit 3.5-year highs as traders tried to figure out how the sanctions will impact global oil supply.
That's what makes the oil market so fascinating, is that it's really a very interesting interplay of financial markets, the economy, and those are two very different things, the currency markets, geopolitics, and the environment.
The energy industry is sure to evolve, and it remains to be seen what role oil will play in the future. But for now, the oil markets remain a powerful force in the world of economics, geopolitics, and your commuting budget.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.